One of the biggest contributors to my returns over the last few years has been what I would call the speculative positions. So a speculative position is a stock that's speculative, it has a lot of risk, but it also have massive upside. So what I normally do is I size it accordingly in my portfolio. It starts as a small percentage of the portfolio, then I add a little bit over time. If I'm right on the stock and the stock goes up 10, 20, 30 times, I make a lot of money and it adds a lot of profits into the portfolio. But if I'm wrong on this investment, I don't lose too much. I lose 0.5%, 1%, 1.5% of the portfolio, which is nothing too crazy, and I move on to the next one. And those have been the biggest contributors to my returns. One of the most popular one, which I get a lot of heat on, was Hims and Hers. And as you can see here, I started buying Hims at $7 per share at a 1% position. Then I added more over time, and it's up over 400% for me on Hims. I also shared Mama up more than 780%. But I have another one. It's mainly a new one that I've been talking about recently, and this is my new speculative stock. And if I'm right on this one, I'm going to make up to 20x on the upside, or almost a 2000% return. If I'm wrong, I'm going to lose a small percentage of my portfolio and move on to the next one. So I hope you enjoy it as always. And this stock is Ouster. Ouster is up 16% year to date. It went down a lot. And of course, I got called a scammer and all these things, and then the stock recovers, and it's been a good recovery. Now, Ouster is mainly a bet on physical AI. We've been training all those AI models and everything, and now is the time to apply them to real life applications, to robotics, to automation, industrial, and just automating regular tasks in general. This is a massive mega trend, not just because of AI automation, but AI automation itself is a trend due to expensive labor in the United States. And we also had a lot of immigration stuff happening in the United States, which is expected to reduce the labor workforce for a lot of those jobs. So automation is key, especially industrial automation. And Ouster is a leader in industrial and is a leader in automation in general. And they mainly sell cameras and LiDAR sensors, and they call it the eyes of AI, because if you want those automotive cars to drive by themselves, if you want the Amazon robot to deliver things, they need a sensor. And Ouster sell those sensors, kind of like how NVIDIA sells the chips. Ouster is selling the sensors, and they operate in 4 different areas. The first one is robotics. So you could see it here on this robot, which is mainly a serve robotics kind of a robot. So it delivers food and other things. And this is the sensor over here, the LiDAR sensor for Ouster. This is the legacy business of them. And I believe their biggest customer is actually Serve Robotics, and they use Ouster LiDAR sensors. Then they have industrial. So a lot of forklifts and other kind of lifts have been using a lot of Ouster related sensors. Then they have smart infrastructure, which is mainly a lot of things where they have the traffic monitoring system and traffic related cameras. This is a big business for them, which I'm going to talk about a little bit more. And of course, they have automotive. Although automotive is the smallest percentage of the revenues, they mainly specialize in robotics and industrial related automation. The company has over 10,000 customers, and I'm going to talk about some of those customers. The first one is Amazon. So a lot of the robots within Amazon, they actually use Ouster LiDAR sensors, and Amazon itself holds about 3.2 million of warrants on Ouster, and they exercise at a price of $50 per share. So the Amazon protest-related robots, they have a Ouster LiDAR sensor, and Ouster and Amazon have a long-standing partnerships, and Amazon keeps on buying those kind of sensors from Ouster. The second one is Anduril. So now we have a lot of things happening within defense, drones, counter drones, and a lot of defense-related stuff. Anduril is the leader, and also Shield.ai. Shield.ai and Anduril, they both use Ouster LiDAR sensors, not because they want to, but because they have to. And the reason why they have to is because Ouster is the only one that has the UAS related certification, which is mainly a certification that it's made in the United States. It adheres to the standards of the United States, because the United States military and defense applications, they're not going to be using cheap LiDAR sensors from China or from somewhere else due to national security concern. So there is a certification process that a lot of companies have to go through to be able to be eligible for a lot of those defense-related applications. And this picture says it here, where those companies, they are bidding for a certain contract, they have to use Austor LiDAR sensors. So this is pretty amazing for the company. Now, if you remember in the beginning of the video, I told you about the smart infrastructure system. And this is by far my favorite part of the Austor related system, mainly because they don't only sell the hardware for it, but they also sell software related solutions. And if the county and all those cities they want to monitor the traffic, they typically buy a software solution from Austor, and that brings Austor high margin recurring revenue. So over time, it's not just a hardware company, we're getting recurring revenue from software, and it also expected to kind of spin off the software related revenues, and they will show you how much hardware, how much software. Now it's not as significant, it's not too significant, but they are expected to start to spin it off in the future. Now, the biggest risk for Austor and for any US company selling anything related to hardware is Chinese competition, because Chinese companies, they make really good products at a much cheaper price. Well, this is not really the case with Austor, which is why I invested in the stock. And you have the company Hesai. Hesai is the leader in China in terms of LiDAR, especially automotive LiDAR, and it's actually profitable. They're making massive profits on those LiDARs. They're very cheap, and they're actually really good products. But very recently, over the last year, the Pentagon has added Hesai to the blacklist in the Pentagon, mainly because they believe Hesai contributes to the Chinese defense industrial base. So those kind of LiDAR sensors are not going to be used to monitor traffic in the United States. They're not going to be used for defense applications, no matter how cheap they are. Why? Because of national security concerns, which gives Austor, you could say, some kind of a competitive advantage in smart infrastructure and in defense applications, where it's the only company that's approved for a lot of those different kind of jobs. And actually, there was another bill introduced, which is to ban Chinese LiDARs completely, even in automotive, because a lot of the Congress people, they were saying that if we have a war or something with China, maybe China can disable those cars from space because they have the sensors and they control the sensors. So that's also a national security concern. And if those get banned too, then Austor will have little to no competition from China. But Austor, in my opinion, is largely shielded from Chinese competition because they're focused on critical areas such as defense and traffic monitoring system, where the United States will never use Chinese LiDAR for such critical applications. So it's a really beautiful setup over here. Now, very recently, they acquired a company called Stereolabs. And Stereolabs is mainly a camera-related company. So the main argument around Austor is that it's LiDAR, and Elon Musk hates LiDAR, and not everyone likes LiDAR. Although LiDAR is the main business, but now they are also diversified, and they entered the camera-related business. And you can see the humanoid over here. The humanoids, they don't use LiDAR sensors. They're too big, too expensive. They use camera-related sensors for nearby kind of sensing and applications. LiDAR is more long range, and this is more, short range. So they use cameras, and now Austor has exposure to the humanoid and human-related applications. This is another sensor that is like a sensing sensor. It's a little bit too big, to be honest. Maybe they can work on it. But they're shipping a lot of those sensors, and now Austor has exposure to this area, which is really amazing for the company. Now, in terms of competition in general, again, people believe that this is a commodity and they have a lot of competition. Well, if they have a lot of competition, then why is Austor putting up 42% gross margins? The recent quarter, again, was bumped up due to some one-time royalties, which they may not collect again. But on average, it has been 42%. If there was a lot of competition, margins would be like 10%, 15, 20, and they would be shrinking. In this case, or even expanding. And the reason for that is because Austor doesn't really involve itself a lot in automotive LiDAR. They are in automotive LiDAR, they compete in automotive LiDAR, but they're not really, you could say, specializing in automotive LiDAR, because this is where the biggest competition is from China. This is where Innoviz is. This is where AEVA is. This is where Luminar was, which actually has gone bankrupt. And a lot of the LiDAR stocks have gone bankrupt, with the exception of Austor and 2 to 3 others. But this is a massively, you could say, competitive related space, but not much competition in industrial and robotics, because Austor has been there for many years, and they have, you could say, a technological advantage in this area, and they have some loyal customers, and they can command much higher margins. but you also have the software business, which is commanding higher margins. So 42% is an indication that there's not as much competition as you believe. The company has also been putting up very decent revenue growth. Almost every single quarter, they have grown in revenues. And you can see the trend here. Revenue growth has actually been reaccelerating over the last few quarters, which is really amazing to see. Now, I'm going to talk about the bearish thesis, or you could say what could go wrong, or the risks with Ouster. And there's a few risks. The first one is the fact that Ouster is unprofitable. The company is not expected to turn profitable before the mid half of 2027, first to second half of 2027. So maybe next year, they can potentially turn profitable. Now, they did turn profitable this quarter due to the royalties, which we don't know if they're sustainable or if they're unsustainable. If they're not sustainable and not counting them, they're expected to be profitable by mid to end of next year in 2027. So the company is unprofitable. Due to that, they've been issuing a lot of shares here, and the shares outstanding have been, you could say, increasing a lot for Ouster, like 2 million almost every single quarter. And that's a lot of dilution. I'm not a big fan of dilution. It destroys shareholder value. But if a company is at an early stage of the cycle, sometimes they have to dilute the stock until they become profitable. But there's another reason why they're diluting stock, and this is to have a large cash position. The company has 200 million in cash and no debt. So they have a lot of cash. And the reason for that is they want to show their customers that they are solvent, that they're not going to go under because of a lot of debt. This is what happened to Luminar, and the stock went to zero. They could not fulfill the Volkswagen-related orders, and Ouster doesn't want to be there. So they want to show Amazon and all these companies that they are reliable partners and they can trust them with larger orders, and that the company is not going anywhere. So it's not as bad as it looks, but I really want it to slow down, and I hope it's going to slow down more whenever the company turns profitable. Now, in terms of guidance, they're guiding 30 to 50% revenue growth, which is absolutely crazy, and only a 5% increase in operating expenses. So they're trying to grow revenues almost 50%, operating expenses 5% for them to potentially turn profitable next year. And as you can see here on earnings per share basis, they're losing less and less over time despite the dilution. So I have a lot of confidence in near-term profitability. Now, in terms of my valuation model, this is what I used, the current number of 170 million. Now, you have to remember, the Ouster is going for over I would say, $10 to $20 billion total addressable market. We are in the early innings of industrial automation and physical AI in general, and the revenue is only 170 million. So that tells me there's a lot of growth ahead, okay? Now, for me, this is a long-term investment, so it's a 10-year hold. I'm using 10-year numbers, and I'm also using 35% revenue growth. People will disagree. They will say it's unsustainable. But for me, on 170 million starting revenues, I think 35% is very, very sustainable. The guidance is 30 to 50%. So I'm using the lower end here of 35%. Again, I believe the company is too small. I think it's sustainable for 10 years. If I'm right on this assumption, I get about $3.4 billion in revenues by 2030, I should say 2036 right now. We look at the multiple, it's trading at 6 times enterprise value to revenues, which I personally don't believe is too much. I think it's fair. I've seen a lot of similar companies with a good story. They're with 50% revenue growth, 30%. They're trading at 10, 15, 20, 30, even 40 times sales. I think 6 times sales is personally not expensive at all. I would be comfortable using 6 times sales to 10 times sales as my valuation model. So this is what I'm going to do. I'm going to take the 3.4 billion expected for 2036 or 10 years from now. I'm going to time it by the current multiple of 6 times sales. So assuming no multiple expansion, no multiple contraction, I get about a $20 billion enterprise value. The current enterprise value, as you can see here, is about 1.5 billion. So I divide it by 1.5 billion. I get almost a 12x over the next 10 years using no multiple expansion. Now, if Ouster becomes what I believe it could become in terms of a Palantir-like potential with software and with many different things, it could potentially trade at 10 times sales. Maybe it's a stretch, but it's possible. Now, if it trades at 10 times sales, we get a $34 billion enterprise value. We divide it by the current enterprise value of $1.5 billion. This is about a 21x over the next 10 years. And even if you want to use half those multiples, let's say you want to use 3 times sales instead of 6 times. Instead of a 13x, you get like a 6x over the next 10 years. To me, it's still not a bad return at all. So I believe Ouster is still presenting good opportunity over here. I showed you the risks, I showed you the upside, and I told you guys that this is a speculative position. So it's a small percentage of my portfolio. If I'm right, I make a lot of money. If I'm wrong, I don't lose too much. And if you're interested in knowing when I'm buying those stocks, when I'm selling them, like I first entered Ouster around $19, $20 per share. So if you're interested, I share all those things in my group in real time. This is the link again. But thank you for watching. It was not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.